the opening test. Now, based on that opening test, I now have a measure to the downside if it were to break south, because that's now a big volume sell trade, isn't it? That's a big volume sell. So if that is a big volume sell and it breaks out, where do you think they're going to buy it from? Here, right? There's going to be an opportunity to buy into that as a story, correct? Well, that's exactly what happened from the cash market open, right? Exactly what happened from the cash market open. So when you see that trade narrative from the cash market open, is that exactly what happened? The opening test, there's the opening test there. There's the discount price there. We bought into that at 50. Remember, this was also a massive wholesale price at 39.50s. And obviously, when I'm looking at that shape and that narrative, I'm thinking, okay, we'll try one sell here, which was at the prop stops, right? So we had the prop stop target price, and obviously we had value divergence at that stage. So I had a prop stop sell, failed auction, scratched out, sold it again, back to the half-back trade, and Bob's your ante. Bob's your ante straight through, and obviously based on the next market measure, you can obviously start to understand that this is now just hit the target price again. There it is just there. There's the target price just there, and there's your profit take right there, guys. We said it would probably get back to the previous swing highs. It hasn't obviously quite managed that. Well, I tell a lie. It has. There it is there. So we said it would trade back to the previous swing highs according to where the value is. It's traded exactly to the previous swing highs at exactly where the value is. And did we know this in advance? Well, I think we did, because I told you I'm a buyer of equities. I told you we're buying these downticks. I told you all about this trade before it all happened. We even gave you an idea after the CPI. I says, right, I'm going to be buying these discounts, right? I'm going to buy these discounts. That was not a hot CPI number, guys. It was hot air, but you can't say that 0.3% is hot. It's not. It's quite cold, actually, but it's hotter than expected. That's why we got the sell. And that's what we've got to remember. There's a macro and a micro world to this, right? There's a micro and a macro world to all of this information. And if we can't separate the two, we're destined to make the same mistakes over and over and over and over and over again. And that's just useless, guys. Absolutely useless. So make sure that you know this stuff before you start trading. Otherwise, you're destined to make horrible, horrible trades. The one thing I did want to see, obviously, was what happened to the inflation, guys, when the numbers did come out. Did they become incredibly bullish, or did they become incredibly bearish? Well, when the inflation, guys, came out, let's take a look at the inflation break-evens since the cash market opened, because obviously the numbers are now valid from the cash market, right? So it's only the bonds prior to the cash market, but obviously from the cash market open, we can get a better look at this storyline here. So obviously the inflation trade finishes at 9 o'clock. So when we see the inflation trade finishing at 9 o'clock just there, we obviously were aware that that was very bullish bonds, which it was. We got a massive uplift in bond prices. That's why we were buying bonds last night. That's why we made a fortune. After the data came in a little bit hotter than the pricing was up here. So after it came in hotter than the pricing, it was way down here. Well, if we look at the bond price against the inflation break-evens of the relative value in this, where do we get to? Here's the low of the inflation break-evens. I'm just going to draw a line across here to make sure we get an idea. So there's the low of the inflation break-evens. If we take it to where we actually had the baseline in there, we can see that that's where the bond price is. Well, if inflation break-evens is here and the baseline low is here, that means bond prices should be trading at this point. Well, what the hell is that away down here, guys? What the hell is even that, right? What is 152? It doesn't make any sense. 152, it should be trading nearer 154. Does everybody agree with that? In other words, they've oversold that data. Just like they did on equities, they just did the same on bonds. Now that happens all the time, and I'll explain why. I'll explain why in a second here, guys. Okay, so what happens, of course, is why does this data always get oversold, overbought? Why is a spike in data always oversold or overbought? Well, unfortunately, it's to do with liquidity and it's to do with algorithms. In the olden days, once the data comes out, liquidity is usually still used to be there, right? There was always somebody still trading, okay? So in the olden days, this is what happens. So we come into a data release here, and the liquidity is maybe here, okay? So the data comes out, and it's a very bullish number. So the guys that are providing liquidity, some of them are still in here, and some of them are still in here, and some of them are still in here, because remember, these are human beings. These are human beings, okay? So because these are human beings, the price comes up. The price comes up. The price comes up. The price comes up, etc., right? Now, nowadays, they're not humans. It's all automated. It's all computerized. It's all digital. So when the data comes out, where's the seller? Yeah. So when the data comes out, that's where the seller is, right? So what happens? That's what happens, right? You see the difference between computerized? You see the difference? When it's computerized, we end up getting this very, very fast and furious move. Now, what does that mean? Well, what that means is that as traders come into this phase, we get a real read on liquidity, right? So buyers come in here, buyers come in here, buyers come in here, buyers come in here. So we maybe still buy in these downticks. We still add to this position. But what happens when we get these buyers, the retail trader buyers, the prop desk buyers, the algorithms fighting over each other? Because remember, this is an algorithm that's pulled away the liquidity, but also at the same time, we have the algorithms all bidding into this, right? Trying to get filled. These are all momentum algorithms. Well, what happens in the olden days is that we would get a spike in the data like this, and I'll drop the scale down a little bit. We'd get a spike in the data like this, we'd get a pause, and then we'd get a spike in the data like this, and we'd get a pause, and we'd maybe get a spike in the data like this. Now, what happens, of course, on a smaller scale is that when we get this here, we get a spike in the data like this, we get a tiny little pause, and then we get a spike in the data like that, because it's all algorithmic. And by the time the retail trade can get filled, it's probably going to be somewhere up here. It's all algorithmic. So why is that important? Well, that means that the market's overbought. The market has gone too far most of these occasions. So when I see a big hot number, and it's not actually that hot, is it? So if I see a very hot number, I would never try and fade it, of course. But that wasn't a hot number. So when I see a number like that, I'm just simply looking at it saying, you know what, I think that's overplayed. And I just wait for the first big volume to come in, lean against it, make sure the price has stopped moving, join after the lean, and try and capture the first elements of that first move away from that overcooked narrative. And that's what we've done on equities, isn't it? That's exactly what we did in equities. Take a look for yourself. It's not that difficult to spot, guys. Look at where the price came from and where the price went to. You couldn't make this up, could you? You really couldn't make this up. The previous low. So I'm looking at this already and I'm thinking to myself, right, we liked this trade, didn't we? We liked this trade yesterday, so I like this trade again this morning. So there's the overcooked trade there. So any discount to that's probably well overcooked. Now's time for me to trade. So I traded this one and I traded this one, and there's the money. Simple. And that's us probably finished for the day, right? You're probably saying that's us. We don't have anything else we need to do here. We've made our money for the day. Pack your desks up. You're finished. It's massive profits, massive profits. If you just followed what I said, you are able to pick up a buy trade from the bond lows at 152s to 154.5. That was a $2,500 profit for the bond buyers. And if you took what I was talking about on the equity trade, you've just seen a fantastic equity trade from a low price at 39.50s to a high price of 40.30s for another $4,000 profit on the way back up again. So here's the other point. Do you have to sell the gamble? If you're wrong, you're losing $4,000 or making $4,000. Well, that's not a good chance. That's not an even money chance. That's a terrible joke. That's a terrible bet. I'm either going to make $4,000 or lose $4,000. That's not going to be a good bet for me, is it? So you don't need to trade the gamble. You trade the pricing in structures. You close out your trade ahead of the numbers. You wait for the overbought or oversold, the heavy longs or the heavy shorts to be exposed into the data release, and then you execute once that data is visible. You execute according to your read on the data and read on the values, and from that, you're either making the big monies or not. So I can make $4 with a lot less risk. I'm not risking $4 to make $4. I'm risking perhaps $100 to make $4. Massive difference. Massive difference. So there's no requirement for you to deal the gambles. No requirement at all for you to deal the gambles, guys. Pretty good stuff, isn't it?